Mortgage industry, housing experts, and Fannie Mae economists are expecting interest rates to ease. While Fannie Mae does expect mortgage rates to drop below 6% by the end of this year, that's for the 30-year fixed, the government-sponsored enterprise also forecasts that if there is not significant supply growth and buyer demographics remain strong, home prices will rise once again, believe it or not. When will the Federal Reserve cut its benchmark interest rate? Fannie Mae expects the reduction to come as early as May. The following are excerpts from a recent Housing Wire interview with Doug Duncan, that is Fannie Mae's Senior Vice President and Chief Economist, and also Mark Pallam, Fannie Mae's Vice President and Deputy Chief Economist. So it gives a little insight as to what Fannie Mae is expecting. Now, Fannie Mae calls for mortgage rates to actually dip below 6% by the end of this year, but you also project that a decline in rates won't be enough to incentivize existing homeowners to move. How much will the inventory shortage contribute to the rise in home prices this year, asked Housing Wire. And Doug Duncan answers, if mortgage rates get down to 5%, then I think there is a nonlinear piece to it, but it depends on what happens with income. If incomes are not rising, then you may not get that move. And we are forecasting slow growth. If there's not a significant growth in housing supply and demographics are still quite strong, that could simply suggest price increases again. We have home prices increasing 3% in 2024. Then Housing Wire asks if Fannie Mae removed its explicit call for a recession in 2024 they made earlier and now expects below trend growth. At this point, how high is the risk of a recession? Duncan replies it was more of a marginal move from their earlier perspective, and there are many things that are correlated with recessions in the past, and many of those indicators are still pointing in that direction, such as an inverted yield curve, leading economic indicators that have fallen for 21 months in a row, and also a decrease in temporary work. Now, the market has got a little too enthusiastic in their view, so the change in their view on the Fed was only to change the number of cuts from 3 to 4 in 2024 with slow growth in the housing market. Now, Housing Wire then asks, compared to the beginning of January, more investors believe that an interest rate cut in May is more likely than a cut in March. So it's been postponed a bit. Why do you think investors are throwing in their hats for a delayed rate cut? Duncan answers that they think the markets were a little bit too over-optimistic, and a couple of Fed governors went on and walked it back, making statements along the lines of, let's make sure we're moving carefully. And I think that was the primary reason behind that. Next question is, what is your expectation for the Fed's timeline to cut their benchmark rates? Duncan looks at May, June, December, and somewhere in the middle of there, where they may pause after the June meeting to see what the data looks like after a cut, and then it's an election year, so it gets a little tricky to figure out just when the Fed will make their moves. And we have some good news, or at least welcome news for West Coast professionals. NRMLA announced that they will be returning to the Western United States for their 2024 annual meeting, which will take place quite a bit earlier than we've usually seen in the calendar. Now, you want to make sure that your kids are ready for school before you go to NRMLA. So that's just a little bit of a hint, according to Housing Wire. Now, the 2024 NRMLA annual meeting and expo will actually be held in September 24th through the 26th at the Hard Rock Hotel in San Diego, California. And that was the last location in 2018 in San Diego. Of course, last year we had it in Nashville. Of course, in 2019, with the Nashville annual meeting, it was well regarded, but we were just at the beginning, just pre-COVID actually. And so then they went into a virtual format in the following years of the pandemic. But we had Nashville in 2023, and I think we were all very glad to see each other again. But that 2019 event inspired the selection of Nashville to be hosted, and that was also well received by attendees. But it looks like we're going to be returning to the beautiful San Diego Harbor, and that will be welcome for many of the originators, of course, in California and the Western U.S. So mark your calendar, September 24th through the 26th, and plan accordingly. We'll see you then. And for our final story this week, the Gainesville Register reports with the cost of housing and grocery surging, or inflation, many retirees have seen their budgets really being stressed by simply trying to maintain their existing quality of life. And many Americans do believe they're going to need significantly more than $1 million to afford a comfortable retirement. That according to a recent Bankrate survey. But fortunately, a new study is suggesting that many people that are concerned about the prospects of enjoying their retirement years could actually be boosting their retirement nest egg with the help, you guessed it, their home. In an October report by Vanguard, researchers estimate that roughly a quarter of Americans 60 and older could move to a lower-cost housing market and then extract equity from their home to bolster their retirement readiness. Now, that study finds that homeowners 60-plus with home prices near the national median could have relocated and extracted on average $99,000 in equity from their homes as of 2019. Home ownership does remain the cornerstone of financial security for most Americans and especially for retirees. So could these people be missing a substantial financial planning opportunity by overlooking the equity that's available from the land and the roof right over their head? With input from local financial advisors knowledgeable in real estate, seniors can make better decisions on whether the benefits of a retirement relocation strategy actually outweigh the change of address and forging new friendships and being maybe perhaps a little further from family. Last year, roughly 80% of Americans age 60 and older own a home, and that suggests the value of home equity often outranks other retirement savings plans. And considering that as of the 2020 census, fewer than 60% of baby boomers in the country actually have a retirement account. So we know where that money is. And that's a wrap for us. And just a note for our viewers, we will not have a video edition of this podcast. That will be February 12th, but we will have the audio edition. So be sure to check your email and you can listen for that particular week. I'm going to be out on the road visiting the East Coast, but I wish you all well. Don't forget, you can subscribe to the audio version of this podcast on Apple Music. We're now on Spotify as well. And of course, be sure to go to HECMWorld.com if you've not done so already. There you can find our latest breaking video commentary and analysis for all things reverse mortgage. Have a great week.